Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, in this episode, I want to get into kind of a variety of sort of things that are happening in the environment, really around policy uncertainty. So obviously, a lot going on in D.C., worries about what things like tariffs are going to do to the economy, to inflation, how the markets are reacting to all that. And so think of this episode as really just trying to sort of walk through some of those observations to try to make sense of what's going on, but start to bring into focus something that's pretty important, which is the level of interest rates, how they're moving, how they're not moving relative to what we might expect in this environment. And again, I would say that topic and maybe a related topic on Fed policy will probably be with us for the next few episodes. So anyway, let's jump into it and start with the environment. So we know that there's been significant change in DC, and there's lots of ways to try to gauge that. One is an index. It's called the Economic Policy Uncertainty Index. And, you know, the punchline with this thing is it's elevated to a level last seen during its peak of the pandemic. And so, you know, numbers are numbers, but this index now sits at 434, and its 25-year average is 118. So think of it as however this index is measuring kind of the idea of policy uncertainty, it's really kind of jumped up. And, you know, in some ways that, of course, has investors and consumers, business leaders, people are kind of worried. They're kind of spooked with what's going on. And so that's something that is on everyone's mind and is influencing certainly spending decisions and then market reactions. Now, another thing that's in focus is the idea that inflation is likely going to come back up and move higher as a result of tariffs. Now, the good news is that when we look at the last couple of months that are measured, February and March, a couple of the kind of traditional inflation indices, the consumer price index and the producer price index, have actually gotten down to levels at or below the Fed's 2% target on an annualized basis. And so, for example, the CPI was 0.2% in February, 0.1%, and actually declined 0.1% in March. And then core CPI, which excludes food and energy, rose 0.1% in March as another example. And then the producer price index basically it has also softened a lot. And so, again, I think that's important information to just see that, hey, well, we're going to look for future inflation. For now, for the last couple of months, interestingly, inflation has actually cooled down to where the Fed has wanted it to go. So we'll see if by chance that's sustained. But again, everybody's focused on the idea of looking forward that inflation is going to go back up because of tariffs. Now, here's one metric of that, and this really captures the investor view. It's a 12-month break-even inflation rate. And so think of it as how to gauge the sort of price and yield differential between nominal bonds and then nominal treasuries and treasury inflation protection securities, so TIPS. And basically, you can impute from all that what the market thinks the break-even rate is going to be over the next year. And that number is 3.1%. It's come up. It had gotten at, and I think below, the Fed's 2% target. But investors basically are implying the way they're investing and pricing those securities an above 3% inflation rate for the next year. Now, for the consumers, and there's a few different surveys, but one's from the New York Fed. There's basically a one-year inflation rate forecast, if you will. The median expectation among consumers is 3.6%. And so, again, two metrics showing opinions about the future, and implicit in that, or explicit in that, I guess, is our worries about prices and where prices are going. Now, another factor is with the friction that happens as a result of these trade, the quote unquote trade war, but it's really negotiations and tariffs and all that, is the worry about a recession. And so the New York Fed also produces a probability of a U.S. recession over the next 12 months. That's risen to 30%. And actually Bloomberg has a forecasting model which also is at 30%, up from 20% during last year. And so, just think of it as, and there are some forecasters, by the way, saying, hey, we're going to have a recession, but there aren't that many that are saying that. But, it's almost like this idea that all of this, and it's friction out of tariffs, but also the uncertainty causing companies to pause, or individuals to pause in terms of spending, essentially, which is in focus. And so anyway, that's another factor that's in focus here. I will mention briefly that those two things, so think of it as the potential for a real slowdown in the economy and a recession, coupled with the idea of higher inflation, really puts the Fed into a box, in the sense that they need to, their job is to try to keep inflation down, but at the same time, quote unquote, maximize employment as part of their dual mandate, which means, hey, keep the economy in a good spot. And so these forces are going to make that a little bit harder. And that's, again, probably a topic we'll get into in the next week or two. In any event, how's the market reacted to all this? And, basically, I'd say that and this just because of when we cut the data and all that, market, I think, was down. Right now, it's April 17th. On the 16th, it was down a little bit. But just to a point of date calculation, through April 15th, it is just where we grab these data points. Basically, market was down. The S&P 500 year to date, just shy of 8%, so 7.9%. And the PE ratio has gotten more in line with its 10-year average, which some would say reflects fair valuation. So we shouldn't be that surprised by this type of adjustment, basically. And then interestingly, when we look at our capital market assumptions, these are assumptions we develop for a 20-year view of the market. We basically model both an expected return as well as the variation or standard deviation of return each year. And the kind of the punchline here is that there's a 17% chance in any given year by our models that we're going to have a negative 8% return or worse. And so think of that as expected to happen once every 6 years on average, right? So I think the reason I mention that is just simply to say, hey, a decline like this feels a little bit painful, but it isn't that unusual, and we shouldn't think of it as that unusual. So anyway, so that's the equity market. But now let's turn to interest rates. So what's interesting about interest rates is the idea that the interest rates normally, if the market's thinking the Fed's going to cut rates and the market's thinking there's going to be a recession, usually what happens is that the 10-year Treasury yield kind of in advance thinks, oh, this is all going to unfold. So the rate actually starts to fall. But over this sort of window that we're looking at, basically interest rates have risen. They've gone from 4 to 4.5% from April 4th, that was Liberation Day, to April 11th. That was the close right before the announcement of a tariff pause, right? So it really captures that fear. And yeah, the rate's fallen a little bit, but it just is sort of moving in a direction different than folks would expect. And so all of that is to say that that topic, in a way, deserves some real attention. And, it does obviously influence, among other things, the cost of our debt, and influences how mortgages get priced, how credit cards get priced. So, these interest rates, they mean something in terms of how the economy functions. And so we're going to, spend a little bit more time on this. And just again, I think one of the observations is what everyone's watching for, even though these are very incremental changes. When we see sort of a disconnect, what we're interested in understanding is to what degree that relates to really the bondholder. Is the bondholder basically signaling, hey, I want a higher yield to hold U.S. government debt. And is there some worry about the debt that's being sort of reflected in that bidding, if you will, in terms of yields? And so that's just something that, again, I think deserves some keen focus as we look forward. So anyway, I know that's a lot. It's sort of like unpacking a lot of what's going on, trying to interrelate what's happening. As mentioned, I think we'll get a little bit more into Fed policy and the challenges with tariffs in the next episode or two. But really do appreciate you taking the time to listen, and we'll talk to you next time.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.